Well guys, what a difference a year makes. I remember back to the same exact time last year, I was stuffing every dollar I had into the stock market. I was buying as many stocks as I could across various different industries. And I believe I even got to a point where I got under my golden rule, which my golden rule is like always keeping at least 10% of your net worth in cash. I believe I actually broke that rule at this time last year. I was stuffing every dollar I could into the stock market. I was buying stocks left and right. Here we are, we're about to go into 2020 now, and it's a completely different situation for me. And I've actually pulled back a ton in terms of new buys, and I'm actually going more cash heavy going into 2020 than I've ever been in any year by far and away. And when I mean cash heavy, I don't mean actually like physical cash. I just mean whether you have money in checking accounts, savings accounts, CD accounts, or those sorts of things. Money that's not invested. It's just like you can easily convert it into cash tomorrow, or money that could be invested in a snap of fingers, okay? So what I'm going to do in this video here today is I'm going to take you through a bunch of different slides, and I'm going to show you exactly why I personally am very cash heavy right now, and why I'm not deploying a ton of money into the stock market right now, and why a lot of the stocks I hold, I'm just holding now, and I'm not buying a lot of new shares. So I hope you guys really enjoy this. Hope you enjoyed me sharing this with you. Make sure you guys smash the thumbs up button. Leave me in the comment how much cash you guys have, not as a dollar amount, just like as a percent, okay? So we're starting out here looking at the public account, which is available for everybody in my private stock group. They get to see every single move I ever make in that account. And in terms of the stocks in this particular account, all these stocks have been bought within the last, like, let's say 3 to 18 months, maybe 3 to 24 months. But needless to say, all these stocks we've held for less than 2 years, and many of these stocks we actually bought in 2019 at some point in time, okay? And when I look across these stocks, I see a ton of huge gains, and I don't see a lot of stocks that I really want to buy more shares. And look at something like a Cirrus Logic. We're up well over 100% on that position. Do I really want to buy Cirrus Logic when we're up 100+%? I don't, okay? Same exact thing with a stock like ELF. We're up over 100+%. That was a 2019 buy, okay? We bought that stock in like February, March. Do I really have to go run out right now and buy some ELF shares up 100+%? It's not something that excites me, okay? Facebook, I look at Facebook, okay? We're up 31%. I can make an argument that Facebook is still a pretty good deal on a long-term basis here, even though we're up 30+% on that stock. But it is already my biggest position in this particular account. And how big do I want to make my biggest position? So that's something I always kind of go through. So it's not that it's overvalued or something like that here. And even though it's up 30+%, I could still buy more, and I would still likely make a lot of money on those shares over the next 3, 5, 7 years. But it's not like, we're up 30+%. It's not like I got to go run out there and buy it here today, okay? Fizzy, get dizzy. We're up 30+% on that. Do I really have to go buy some Fizz shares when we're up 30+%? Not really. iRobot's an interesting one because that's a stock we're down quite a bit on, okay? Nearly 9% down in iRobot. If I look at iRobot, there's definitely some value to be had there, but at the same time, I've put $46,000+ in iRobot just in this account alone. I have more money in other accounts in iRobot as well. Because keep in mind, my private accounts usually just mirror whatever the public account's doing. Whatever stocks I'm buying in my private accounts, I'm buying in the public account and vice versa, okay? So I already have a lot of money in iRobot, and it's like, how much money do I really want to have in a stock like iRobot? So I have to really limit myself. So even a stock like that, I can't really buy that much more of it. Maybe I'll buy another like 3,000 or 4,000 in this account and get it to like, 50,000 I have in the stock in total. But I don't want to buy really any more than that in iRobot. It's just a certain amount you're willing to risk when you buy a stock. And I don't want to get iRobot to a place where we have 6 figures plus in that stock. I just don't, okay? You look at a stock like Skyworks Solutions, still pretty undervalued, but it's up we're up 44+% on this stock, okay? And it's a stock we've held for probably a year, a little over a year, maybe 18 months or something like that. And so to get that type of gain, 44+%, it's amazing. They definitely have a lot of amazing things coming for them with 5G, but that's another stock that's creeping up into a very big position. We're talking about current value, and that one's 71,000. If that one continues to roar higher, Skyworks could end up being a stock that's actually the biggest in the entire portfolio. And I'm not sure I really want Skyworks to be the biggest stock in this particular portfolio. And to be quite frank, I'm not sure I want any semiconductor stock to be the biggest in my portfolio. So I'm definitely not going to buy more Skyworks right now, okay? Tesla, I love Tesla. I believe in the company a lot. I own almost 300 shares between this account and my private accounts as well. But we're up 55+% on Tesla shares. Do I want to run out and buy Tesla shares up 55+% when I already own almost 300? I mean, if everything goes away, I think it's going to go with Tesla. You could say it's almost a no-brainer to still buy Tesla shares, but it's possibility. I could be wrong. Maybe things don't go as well as I thought. Maybe, there are some failures down the line. You never really know with these stocks. There's always, you got to take into account the risk reward. And I already have probably $100,000 plus invest in Tesla stock. So it's not really a shares I gotta go run out and buy when I'm up 55+% on them. Ubity Booba stock, I pretty much built out my Uber position, okay? It's right around break even. We're down about 1% on Uber. But I gotta tell you guys, I bought a ridiculous amount of Uber stock in the past 3 months. And Uber is a position where I feel like I've kind of fully built it out now. When I look at how many shares I own in this account plus my other accounts, Uber is still a money loser, and they're probably gonna continue to be one till at least 2021. So it's not like I can, make that into some Goliath position where it's the biggest position in the account or something like that. I just don't want to get Uber to that place. Wynn Resorts is a decent value, but it's not like a smashing value here. We're about 5% or so on that stock. So, definitely some value to be had there. That's a stock I could make an argument that I should buy a little more of. But at the same time, it's not like I got to go run out there and buy it today. I mean, whenever Wynn drops under 100, that's when it really becomes a screaming buy, and I've got to take advantage of that. So right off the bat here, if we look at something like that, and I'm looking at a lot of the stocks I own, why do I want to go run out and buy a lot of these stocks when they're up, 30%, 40%, 50%? Some of those were up 100+%. A lot of those stocks, they might not necessarily be overvalued, but a lot of them at the end of the day, they're not undervalued. And I'm in the name of the game of really buying undervalued stocks, okay? So that's not it. Let me take you through a bunch more things, okay? Let's think about like big tech, okay? Big tech's usually the type of stocks you can build really big positions in. That's one of the reasons I built my biggest position being Facebook, right? And so let's look at some of these big tech names. The first being Apple here, all right? Apple's trading at one of the highest forward PEs that I've seen ever for Apple stock. Keep in mind, Apple generally trades at a forward PE of 9 to about 14. Right now, Apple has a forward PE of 18 on it. And I'm just telling you, for Apple, that is actually a pretty high forward PE. It doesn't mean it can't continue to trade there. I'm just saying, if you look historically at Apple stock, this is a 9 to 14 forward PE company, trading at an 18 now. And that's baking in a decent amount of growth next year, which Apple can probably achieve, especially if 5G iPhones come in the fall time and whatnot. But an 18 plus, forward P for Apple, I'm not paying that type of forward P when this is a company that historically is going to trade at a 9 to 14. It's just much, more overvalued than where it historically is at. Look at something like Microsoft, right? Microsoft right now is trading at a forward P of over 25. Over 25 for Microsoft on a forward PE basis. Remember, that's taking into account the next 12 months of earnings. In my opinion, that is drastically too high for a stock like Microsoft. Microsoft is a stock that should have decent growth in 2020 and likely 2021, but this is not a super high growth stock, okay? This isn't like Microsoft back in the 90s or something like that, okay? A lot of people look at it as kind of a safer business model because a lot of their products are software and like recurring revenue streams and some things like that. And so I can definitely understand why Microsoft might trade at a higher valuation in terms of a forward PE than some of these other stocks in the stock market, but a 25? And nah, that's too high for a stock like Microsoft, okay? Look at something like Amazon. Amazon still has some awesome growth behind it. Awesome growth meaning double-digit growth, okay? They should continue to grow 15, 20% a year over the next few years. But at the same time, this is a company that has a forward PE on it of 64 plus. That's a really dang high forward PE, a 64 plus for a company like Amazon, which keep in mind with Amazon, the numbers continue to get bigger and bigger, so those growth rates will come down, okay? So maybe in 2020, they'll grow 18 to 20%. The next year, maybe they'll grow 12 to 14%. And what happens when Amazon eventually reaches a peak where they start growing single digits? There's a decent probability that could actually happen within the next 3 years where they actually start growing less than 10% revenues. If that goes ahead and happens, what are some people going to do that are investors of Amazon stock? A lot of them that are the growth investors are going to run out of that stock. Valuations will come down. 64 forward P on Amazon, just too high in my personal opinion. I'm not buying Amazon stock there. I love Amazon stock, believe a lot in the business, but I'm not buying it at a 64 forward P, okay? Google McDougal stock. Great company. I mean, so well run. Obviously, they have, ridiculous scale on when it comes to advertising and all those sorts of things, right? You're thinking about the dominant player in search. You're thinking about, obviously, they own YouTube. You're thinking about Android. There's so many huge businesses they have. Forward P of almost 25 on that stock. And Google's, a business that is still growing, and it's growing decently. But this is, once again, not Google, like a super fast growing company. This is a company that's just going to continue to get more and more profitable and become a better and better business over time. But almost a 25 forward PE on Google, a little too high in my personal opinion, okay? Facebook, I can make an argument that this is for sure the most undervalued of big tech, okay? We're looking at a forward P of 22, and they'll actually likely grow net income at a much faster clip in terms of a percent than any of those other companies, Amazon, Apple, Google, or any of those. So if you're thinking about the next 3 to 5 years, I would probably put money on it. Oh, I literally do have money on it. Obviously, it's my biggest position. But I believe Facebook will grow much, much faster than Apple, Google, Microsoft, Amazon, some of those companies. But you're getting at a forward P of 22. So if I'm looking at it, they're the most undervalued of big tech. But I was buying a lot of these shares when it was trading at a forward P of 16 to 19. So a 22, that's a lot higher than a 16 to 19 like I was paying when I was buying these shares, super heavy back in November, December last year, even into January of this particular year, okay? So we've gone through a couple things so far. We went through my account and we saw that, a lot of those stocks have just gone up a lot and they're not nearly as good at deals as they once were. We've looked at big tech now, the big Goliath companies that you could usually build a big position in. A lot of them, in my opinion, are either overvalued or at the very high range of fair value, okay? Now let's go ahead and look at some more stuff, okay? Next thing we want to look at is S&P 500 PE ratios. This looks at the last 10 years, okay? And what we're going to find is we're trading up towards some of the highest PE ratio we have in quite a while, okay? Now, if you think about like 2016 going into 2017, we were a little higher, but keep in mind, everybody knew corporate tax cuts were going to happen. So basically the tax rate for corporations going from 35% to 21%. This was the biggest increase in profitability of corporations in history, and this is something that obviously was a one-time boost. So year over year it made corporate profits look dramatically better, and they were dramatically better because basically the US government went from being a 35% shareholder where they got 35% of the profits to 21%. That's a massive difference. And if you're thinking about, is there some type of magic bullet we're going to have to obviously increase profitability of corporations, there's really not. If a trade deal gets done between the China and US, we will definitely see an increase in profitability of a lot of companies that do business internationally. But at the same time, if you're thinking about something as dramatic as, all corporations going, that U.S. corporations going from 35%, 21%, that was a one-time thing. That's not going to change for probably decades to come in the future. And so if you're just looking historically back at that chart again, it's a situation where we're trading fairly high as far as the PEs. I mean, you look back at, 2010 through basically 2014, it was definitely like shooting fish in a barrel at those particular times because PEs were trading so low. And, it's just not like that anymore. Okay, so if I'm looking at 2020, I think there's a decent probability we're going to have at least one correction in 2020, if not several corrections in the stock market in 2020, where actually stocks could fall quite a bit in the short term, and we could get some actually really good deals at some points in 2020. And I can tell you, if the stock market's hot in 2020, I'll be very worried about the stock market going into 2021 because we would definitely get to overvalued places in the stock market. Remember, a lot of these stocks are already trading at the high end of fair value and maybe pushing up toward overvalued. If we had another super good year in the stock market in 2020, I would consider actually selling stocks, which is something I never do in relation to just like selling stocks to get cash. But if we had a great year in 2020, which I don't think we will, but if we did, I would be a little scared going into 2021. So if I'm looking, I think there's a good probability we're going to have at least one correction in 2020 of a 5, 10, maybe even 15% size, if not a couple of those type of corrections, okay? Something that's going down in 2020 is obviously the presidential election. Now, we're going to have to see how all this shakes out. There's a lot of moving parts here, right? The four main kind of people there is obviously you're going to have Trump, who's obviously the president right now, and the market could look at Trump two ways. They could say, well, the stock market has done pretty good under Trump, and, business in general has done pretty good under Trump. So, you know, the Wall Street could look at it from that perspective and be like, oh, you know, that wouldn't be bad to have Trump another 4 years. They could also look at it from the perspective, let's say there's not a trade deal done in 2020. They could look at it as maybe there's not going to be a trade deal done under a Trump presidency, and therefore they're scared of that, and maybe they don't want Trump as a president for another 4 years. So there's going to be that wild card. You obviously have Joe Biden in there that Wall Street would probably be okay with, but at the same time, I think Wall Street would worry about maybe slower growth under a Biden presidency than like somebody like a Trump or something like that. So, you know, we'll have to see what happens there. I know for sure Wall Street would likely not like Bernie Sanders or Elizabeth Warren. Both of them can definitely come across as anti-business in many cases. Both of them talk about, you know, raising tax rates on individuals and corporations. What's that do for the stock market overall? That would definitely freak out the stock market. So if I'm just looking at 2020, I just look at a year that I should likely get some very good deals in the stock market. And if I'm looking at today, which is what, December 11th or December 10th, whatever today is, 2019, I'm just looking at the stock market with not a lot of great deals. I'm looking at a stock market that is pretty much fairly priced across the board. There's some deals here and there. There's a couple stocks I'm buying right now, but there aren't like that many stocks that I'm buying super heavy. It's a whole different situation between like me flushing as much money as possible into the stock market, into stocks like I was doing in the fall time, into the winter of last year, and this year where I'm very selectively putting money out there in the market in some of these stocks. There's a few good deals, but there's not a ton of good deals in the stock market right now, and that's just kind of where we're at. And that's why I am cash heavy, and I'm not sticking a lot of money into the stock market, and I'm going to be likely the most cash heavy I've ever been in my life going into 2020. And I definitely welcome any corrections and anything that happens in 2020, because you know, I hate holding a lot of cash. I really do. I like to deploy that money. I like to invest my money. I don't like my money to just sit around doing nothing. I like that money to be working hard for me. But flat out, I need some better deals on some stocks before I go ahead and buy a bunch of stocks right now, guys. So hope you enjoyed this. As always, make sure you smash the thumbs up button if you enjoyed me sharing this with you. Make sure you subscribe to the channel and maybe hit that notification bell if you want to be notified every time I come out with a new video on the channel. Thank you for watching and have a great day.